Hello, 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 everyone. Mike Arnold here with the soon-to-be on Bob Iacchino, who's probably why everybody's here to see, because you get to see me all the time. Hey, Daniel. Some days you get the bear, sometimes the bear gets you. Uh, you shouldn't have been that shocked by that. William, just remind me once Bob's done. Well, there's not major technical damage. Just again, minor pullback. Today, we had the S&P Global Services PMI, composite manufacturing. Manufacturing dipped back into contraction. Services and composite were higher than expected. Richmond numbers, some were slightly better than expected, but those are just bad numbers overall. But the big thing was no debt ceiling deal. We'll also get Bob's take on that with what he thinks is moving the market. The take from Bob Iacchino. That's my audition tape for one of the crappy networks. Let's see. Tomorrow we have nothing besides the FOMC minutes come out in the afternoon. I don't think there'll be anything surprising in it, but be aware that 1 p.m. Central, the minutes are coming out. Before that, it's really nothing besides some crude numbers and your mortgage application stuff at 6 a.m. But really the big thing tomorrow, we got Waller. Sorry, I forgot about Waller. I don't know what else the Fed could say at this point, though, that would really shock the market. So that's it. S&P, pretty bloody day besides energy. So you see energy was the only sector that was up. Comm services, after a pretty strong run, was down 134 basis points. The Fed Watch tool, let me do one more refresh. Hey, this is up to 28% for a hike, but the real thing is probabilities are 3 pauses, and the November is edging up to also possibly pause territory pretty soon. And Bob's talked about that before. As a market will slowly come to the Fed, still solidly in greed mode. I'll have to look at. I did not see Palo Alto. I was tied up with some technical stuff before, but I don't know if people are gonna bid that up after earnings. I'll have to see what that was. But at 2,400 and something PE, insane. Tomorrow we got Analog Devices, Kohl's, Xpeng, BMO, Petco, Abercrombie Fitch. Not a lot, but the big one tomorrow is Nvidia after the close. So that is very key. And then you have things like Snowflake. But with that, let me bring on Bob. Hey, Bob, hold on.
What's up, guys?
Hold on 1 second. Now we got a problem because it switched away my displays. There we go. I hate when that happens. So
What's up, guys? Can you guys hear me? See me? I don't know what's going on.
let me just see. Let's see. Good, you guys are getting so many advertisers.
Yeah,
Evening. Hello.
not as good as you might think, Richard.
Uh. All right. All right, so we had a little minor pullback again with my intro. What do you think? What do you think caused this risk off day today, Bob?
Oh my God, it was selling that caused the risk off day.
What? Wait, they're selling? What is that anymore? I don't know what that is.
Um, no, I think today's downdraft, like Mike said, I think this is kind of a pullback, and if the pullback holds, should take us to new highs, not new all-time highs, new very recent over the last week and a half highs. But I think today was driven by three key things, in my view. Number one, those PMI figures. So a couple of things about that first. These are the S&P PMIs. So they're small to medium-sized companies. About 45% of people that have jobs work for small businesses. Small businesses are still responsible for 2/3 of new jobs that are created. That hasn't changed. So these particular PMIs matter, and they matter in the manufacturing sector because manufacturing is a leading indicator of recessions. Okay, when you look at Mostly it's the bigger PMIs that are the leading indicators, but I suspect if the small to medium PMI was weak, the bigger PMI is not going to blow out into expansion territory by huge numbers. It might, but so I think those manufacturing PMIs, not only were they bad, but they were really, really bad in four major economies. And I look at Germany as different than the EU because Germany is the engine of Europe. So whenever I look at data, I always look at Germany and I look at the EU. I look at it as almost separate. That may sound silly because if Germany's the engine of the EU, then some people might say just look at Germany, don't even look at the EU. But I don't agree with that because I think Germany being the manufacturing engine of the EU, that was an unbelievably bad number. Pavneet wants to know why I sound like I'm speaking inside of the White House. I'm sick, Pavneet, so my voice indicates that.
I'm just double checking. Hold on 1 second. Let me double something. There we go. Let me know if you still got an echo.
All right, do I got an echo now?
All right, we need some feedback in the chat.
Yeah, let me know if I still got an echo and if you guys need me to repeat what I just said, which I'm happy to do. I'm going to pause for somebody to reply. I know there's a little bit of delay on my side, so Mike, if you see
Well,
it, let
there's
me
a
know.
delay also with YouTube with the streaming stuff. So,
Anyway, I'll continue where I was, just so that.
still sounds
So
like
I don't know if that's an old comment there or not from Mark.
it should be fixed. I'm not seeing an echo on my end now.
All right. Anyway, I'm going to continue because we gotta keep. I gotta keep this short anyway. Um, so the German manufacturing flash PMI 42.9. I mean, not only is it in contraction, but it's declining. It's 44.5 last month. All right. So that's a really bad number. EU 44.6, 45.8 last month. These are manufacturing PMIs. UK 46.9, 47.8. Thank you, Pavneet. I appreciate it. 47.8 last month. And then, of course, US, which was the strongest one, 48.5, but 50.2 last month. So you have manufacturing PMI headed lower, and manufacturing, even though, especially in the US, we're not really a manufacturing economy anymore. When you have those four major blocks, and again, I'm separating Germany and the EU, having contracting manufacturing, that's not a good sign for the overall economy. That's number one. Number two is the rise in yields. I don't think people realize it, but the 2-year yield's up almost 0.5% since May 12th. Almost 0.5%. The 10-year yield's up 0.33% since about May 12th. 5-year up about 40 basis points, 0.4%. Those are big moves in yields. So again, we got yields going higher, not lower. Adding to that, that's likely due to the Fed speak. The most dovish Fed speaker was Powell, in my opinion. The other Fed speakers, Bullard specifically saying he could see 2 more rate hikes. Raphael Bostic saying that he could easily see rates going higher. Thomas Barkin saying clearly, we need to see more data before we are encouraged, I should say, or convinced that we've done enough. And this fits in with what Jim Bianco said on our podcast a couple of weeks back, that he thinks inflation spikes up again in July. So there's that. The third thing is crude oil. Crude oil is now up about 15.25% since the May 4th lows. Okay, since those and then obviously that spike low makes it seem more exaggerated. But if you go to the May 4th close, still up about a little over 7%. Okay, since basically the beginning of May. And then today we had, excuse me, a warning from Saudi Arabia. I don't know if you guys saw that. The energy minister, who is Prince Abdulaziz bin Salman, basically warned short sellers. Now, in the same breath of him saying that OPEC was going to be a responsible regulator of price, they're out there fully saying that they regulate the price. And they're right. Shale is expected to fall off in production over the next 6 to 12 months pretty dramatically. And Russia is just pumping as full out as they can because they're funding a war. So Saudi Arabia specifically and OPEC generally are the marginal producers, and they do control the price. So he basically said, and I'm going to read a quote here. This is from Prince Abdulaziz bin Salman, the Saudi energy minister, and he was referencing short sellers of crude oil. He said, speculators, like in any market, are there to stay. I keep advising them that they will be ouching. They did ouch in April. I don't have to show my cards. I'm not a poker player. But I would just tell them to watch out. Now, he could be speaking just from a position of knowledge of the supply and demand dynamics, or what his opinion of the supply and demand dynamics are. Or he could be saying in the first week of June at the OPEC meeting, they're going to cut production again. Could be saying either. So what's going to help goods prices go up while services prices are sticky quicker than anything? It would be oil prices, be energy prices. And there's also some fear that, Europe again is going to be facing, obviously we're not anywhere near winter, it's May, but Europe's going to need to stockpile natural gas again to prepare for the next winter. And if they don't have a mild winter, we could see natural gas prices spiking as well. That's a ways off. So yeah, the buildup in short positions in crude oil that we've had may be at risk, and that puts a different price dynamic in for the Fed in the next coming months. So I think those three things are what caused today's sell-off. You can assign any value to any of those three things. But I think the biggest thing is the market still believes when there's positive economic news, that's the dominant narrative. And it's not. Weaker economic news is still the dominant narrative. It is. The New York Federal Reserve puts out what they call a neutral rate. You can go see it on the New York Federal Reserve. You just go to their website, look up neutral rate, and it shows. They say so if you guys don't know what the neutral rate is, the neutral rate is where the Federal Reserve believes that their policy is neither restrictive nor accommodative. Okay, it's not easy money policy, it's not hard money policy. And the New York Federal Reserve released yesterday that they say the neutral rate is 1.18. We're at 5. So that means that actual policy is restrictive by 4-fold. That's going to slow the economy, if that's accurate. So that's what I think this stuff is over the last day and a half, maybe. We weren't strong yesterday, right? Excuse me. That's what I think this move was. And I just think it's a continuation of what is the 3-day narrative going on here, where we got kind of like a weakness in the rally. I don't see technical damage either, Pavneet. Well, Mike said there's not, so I'm not going to argue with him. I didn't see it anyway, so I have nothing to argue about. But, that weakness, that's what I think that weakness is based off of. The NASDAQ has a long way to go down now before I think it's weak. But we're not in a bull market yet.
Yeah, I mean, these were short-term patterns we've triggered, and NASDAQ has even the last breakout point was 13,350. We're trading, what, 13,730. So it's a long way off. And, getting back to the last breakout point, yeah, it is some technical damage, but it's not major yet. I mean, that just takes us back to a key support area. Could anything we have up here start getting worse? Yeah. But until it does,
in this whole NASDAQ bear market, we've had rallies of 15%, 23%, and now we're in the midst of a 28%. And I'm talking about from low to high. All right. There are ebbs and flows in bear markets, especially bear markets that are pinned down by fundamentals. And that's why I remain staunch in my belief that this is still a bear market, not only technically, not only because we haven't made new highs and you can't be in a bull market until we've made new all-time highs, but simply because these rotations are not unusual. They're really not. So anyway, that's all I really had for you guys. If there's any questions, I'll take them. But
Yeah, and what was I always had this up in the beginning, but if you take a look at the volume again, I mean, besides a couple days on the Nasdaq, the sell volume is generally still higher than the the long volume on the S&P. The volume is still going to the downside. I mean, it's leveled out a little more, but it's not like we're on a super low volume day and we're getting the sells coming in. So,
Yeah.
but yeah, the big five is near all time highs.
Yeah, that doesn't mean much to me because if you just buy the big five, that's fine. If the big five is your play. But we also look, tech generally leads out of a bear market. So let me rephrase that. Value leads out of a bear market. First, you have value leading, then growth catches up and passes it. We've never had value go up. So, and the spread between the performance of value and the performance of growth is wider than it's been in decades. That's not a sign of a strong, stable market. So, those big five, I mean, that's great for people who've invested in the big five. And you know, I like to see anyone make money. I like to see anybody make money. So if you invest in the big five, but if we actually go into a full on bull market, the dogs will start to catch up, and those big five may not make money for quite some time in terms of holding them at these levels.
And here you can see the growth versus value, and growth is just since the beginning of January, it's all been growth.
Yeah.
All been growth. So let's see. I'm not seeing any more questions.
Not
So
either.
we're gonna let you go, Bob, because you've been under the weather, and we're gonna
I
let you
have.
get better. And hopefully you can join us again this week.
Yeah, I'll be there Thursday unless you guys aren't doing one because of the
Real
holiday.
quick, do you think anything's gonna come out of the meeting minutes tomorrow?
I think it'll be less of a pause in the conversation, but I think there'll be a lot of conversation about, you know, we might be at a point where we can sit. So I think it'll be a pretty neutral set of minutes. I think the market will take it as dovish, and I think the market will probably rally off the minutes. But then when we delve into it over the next couple of days, we'll see that's not really what it was.
All
Because
right.
that's kind of what the Fed speakers have been trying to clear up. You know, just because in the statement they removed further tightening may be needed, they removed that. Everybody assumed that that meant a pause when all it really meant was it's possible that we're done. You know, I mean, it's the sort of colloquialist world that we live in. You know, it's funny. Somebody told me the other day that, you know, everything is jargon, everything's just a phrase. And I'm like, what do you mean? They said, well, you know, MAGA Republicans is a phrase. Okay. Left wing nuts is a phrase. Okay. Data dependent is a phrase. No, no. Data dependent is the way that they describe what they're actually doing. They're looking at data depending on it for their forecasts and for their actions. So people get upset that they say, "Oh, they say they're data dependent." What does that mean? It means they're looking at data and they're going to decide after they see the data. And then they have speeches where they say we need more data, and that's data dependent. So be careful about like thinking the Fed is full of shit all the time. They're full of shit most of the time, but not all.
One final thing: do you think they'll have a debt ceiling deal?
I do think they'll have a debt ceiling deal, but obviously that's one of the things that could push us to the October lows. That's for sure.
All right,
If they do.
that's where we'll call it a day.
All right, guys. I will talk to you guys Thursday.
All right, thanks, Bob. Bye. All right, just me gonna be run through some stuff quickly. So this came down, you know, first, second key target area. I also would not be surprised to see a bounce tomorrow. We'll be watching for some bottoming pattern in either Asia or Europe, but I would not be surprised to see a bounce. The key level now is back to 41.89. We hit that. Remember, I bumped this level up slightly from this morning. So this hit my full target area. If it does drop lower, the next major area is about 41.23. But we're still, and even with the bounce tomorrow, we got cycles rolling over. We're out of massively overbought. But this 41.23 would be the next key area if we do break below the rotation zone at this point. There's a pretty decent support ledge here, though. So watching for that. NASDAQ, by the way, if you didn't update the levels, when it poked to new highs, I went to the, not to this side, to the conservative side, which is the lower one, and it pretty much stopped at the first target. So we had to update the levels because this, when it made a new high here, the reason I didn't go to this one is that was the more aggressive and the NASDAQ's been stronger. And when the NASDAQ's been stronger, you want to go to the conservative target because they work out better. So, but the key level with the NASDAQ on the bounce tomorrow would be about 13.8. On a continued decline, 13.670 and 13.628. Your Dow still caught after triggering the double, but it's still, this is now a triple bottom, which slightly favors a continuation problem. But remember, we triggered the double top back all the way on the 4th of May, and since then it's gone a big sideways correction. Still expecting the Dow to reconnect over the next few days with the 200. The Russell, we had some wild price action in there today. This, we had that head and shoulders with this, then invalidated the whole thing, so couldn't use those targets anymore, what Sterling brought up this morning. Massive spike up and then reversal and also potential double off the table. So the Russell was just trading insane levels. I don't have much more besides a further decline, 1780. Rally would be back to 1813. What else? The VIX finally tried to get some momentum up here with pulling back into the close, but that's where it was really focused on the downside today. The DAX finally rolling over and coming back to the key breakout zone, but not yet violating. Again, no technical damage. This has so far been an orderly 2-day pullback, still above the breakout levels. The notes trying to put in a little bottoming with cycles at the bottom. Tomorrow I will be paying attention to the high for a %B potential buy with a follow through in the close, but it's going into the rotation zone, so it has to be it's more of an intraday something I'll be watching. By the way, the 10-2s look like they could be set to break down again. I'm going to be keeping an eye on the 10-2s yields. Dollar index, still the potential double is in play, but dollar holding up relatively well today. Now, the only concerning thing is cycles are rolling over, and so far we've had a sideways correction since the big up move on the 18th. But nothing else really to talk about there since this analysis on the morning. Crude really looks like it's going to break out. And if it can power through this 74.60 area, we could see a pretty quick run higher. So that's what I'm keeping an eye on there. Gold, double still in play. The double bottom still in play. Again, lower probability against the rotation zone, but still in play right there. Silver hitting the next target. You see if I move out the retracements, use the next target hit. So that clearly hit, but any rally would be watching for a return to the rotation zone and a rotation back over. There's nothing bullish there yet. Copper broke down from the diamond pattern, as I talked about, but not yet at another key support level. All right. Anything else? Yen, not much going on there. Euro still has a double bottom in play. Bitcoin still caught in a range. Tesla, the 190 call volume was insane today. Boy, it's so coordinated. But nothing's ever going to come of that. Big reversal, though. Big reversal could not sustain the move higher. So I'm watching for some potential weakness, but that would just be back to the rotation zone. And the overall pattern, the weekly double top that was triggered, has not been invalidated yet. With that, for the close, we still have, after tomorrow's close, we still have NVIDIA. We still have Nvidia so far, a 3-day pullback. Still watching, as I talked about, nothing's changed with that. I'm still watching the low from Thursday the 18th. I want, oh, not that. Where is it? I just blanked out. Oh, there we go. What did they do? Oh, you've got to be crapping me. So, a beat, slight beat, 172 revenue. Where was their last revenue number? 165, beat. Well, still in consolidation, but nothing, no damage done to the 25. Now there's your 2500 P to E ratio. Fantastic, off the charts. Just wanted to glance at that. How can it be broken? It can't be broken because it's just the yields. How can the yield curve be broken because it's just two yields? It's the 10s minus the 2s. It's because the market is still thinking that there's not going to be a pause long term. That's why. That's why. But you can't say things are broken. Now, the VIX, because of the way the rotation went to the 0-day expiry, changed. I think we could more say it's, I guess you could call that somewhat broken because of the rotation into short-term options. So it's not as useful. But the 10-2s aren't broken. It's just the market's not buying that the Fed's really going to pause long term. So they're not pricing anything in. I went over gold, Pep. I already went over gold. It's a potential double bottom. Right here, potential double bottom. Needs to take out the high from Friday. All right, with that, that's where we stand. Remember, big thing tomorrow is the meeting minutes. And I wouldn't be shocked. I tend to agree with Bob. If on the first read, if it's anything's taken dovishly, or like it's more weight that they think's being put on the pause, the market will probably have a little snapback rally. But then I'll be watching for a possible next rollover play. With that, I will talk to everyone later. Bye for now.